Welcome to Coffee with the Risk Manager, where we share a cup of coffee with colleagues and discuss all things risk management and higher education. My name's Stacie Kroll, and I'm the Executive Director for Gallagher's Higher Education Practice. And today, I'm delighted to welcome my colleague, Paul Pousson. Paul, why don't you give us a little bit more about your experience?
Thanks, Stacie. Good morning, and good morning, everyone. My name's Paul Pousson. I'm a Managing Director with Gallagher's Higher Ed Practice. I've been with Gallagher, I guess, about 6 years now. Prior to joining Gallagher, I was with a large public university system in Texas as the Associate Director for Risk Management for about 20 years. Had 9 academic, 6 health institutions, the institution at the time. And it's a pleasure to be with you today.
Well, thank you again for being here. So what are we drinking out of today? What's your mug?
This morning we're drinking out of an Ermia mug, an oldie but a goodie for me, and one that fits perfectly in my hand. So it's been here on my desk, Gallagher, for the last 6 years.
So what conference is that one from? Because I've got a couple Ermia mugs in my collection.
Actually, it's from San Diego.
That was a good conference.
2017.
That was a good conference. Today I've got a mug that was actually sent to me after recording our first episode of Coffee with the Risk Manager, and a good friend and colleague sent it to me, and I'm pretty sure that the reason she sent it to me, saying "quick question" there, is because that feels like how every risk management interaction starts. Is hey, I have a quick question, but it's never quick, is it?
It's definitely not.
But anyway, so today, thank you for being here again. And today we're going to be talking about how our insurance buyers can take an individualistic look at their insurance portfolio strategy. So how can we evaluate our risk tolerance and ensure it's in alignment with our institutional financial objectives, our mission, and our strategy? And when we're talking about, risk tolerance today, we're not going to be talking about it in our ERM definition of risk tolerance, but more in the way that we think about assuming deductibles or retentions and what layers of insurance we want to buy in the excess tower, and kind of just our entire portfolio structure, if you will. So one of the things that I've noticed is that when we work in such a collaborative environment, as we do in higher ed, we're often asking the question, what are our peers doing? And, the reason we do this is really to kind of inform our own strategy and to make sure we're in alignment with the industry. And we get these answers through tools like benchmarking or data analytics or, peer data. And those are all fantastic tools to have in our tool belt. But in particular, in a hard market, buyers are going to be faced with having to make tough decisions on their portfolio, and in some cases, forced to take on more risk and insure less, essentially, or take on a higher deductible. So those benchmarking tools and those data analytics become less valuable to us in making this decision and designing this strategy. So what we want to do is kind of inform our audience, help our audience along in trying to level set on how we can do that in the absence of benchmarking data, essentially. So in your experience, what are some of the things that our buyers need to be thinking about when undertaking this individualistic, institutional specific decision-making strategy?
Great question. And I would say, aside from the standard kind of premium credit argument, there's several reasons why insureds would want to consider taking on more risk. Definitely, if there's finite capacity in the market, they may be forced to take it on. Also, to create leverage, insurers like to align with insureds that will take responsibility and have skin in the game, if you will, with respect to their risk management programs. And taking on more risk can attract actually more carriers to your program. It's also to maintain more control. Do you want to avoid that cyclical nature in the marketplace and kind of take some of that out through taking on more risk and putting more emphasis on your loss control programs? Could it minimize your administrative burden associated with your insurance programs? That's another reason. As well as, again, as I said it before, and I'll say it again and again, I think as we talk today, placing more emphasis on risk control and all the great things you're doing to mitigate the risk and getting full credit for that when you're in the marketplace.
Yeah, I mean, again, another thing we're seeing is that, kind of pre-hard market, I think when we were faced with these decisions, you could anticipate that there would be, a significant premium credit, that by an institution taking on more risk, you would see, less premium and kind of those other policies sitting excess of your own retention. But that's not the case necessarily right now. You're not going to get the premium credit that you would have gotten even a few years ago. But I do think, risk managers can be surprised that, it's valuable still bringing this to the table, because for those points that you mentioned, particularly the control and the emphasis on the risk control, is that, CFOs, buyers might be willing to pay more to have those pieces. So even if you don't get that dollar for dollar premium credit that you would expect, it's still a worthwhile exercise. Particularly when our budgets are kind of becoming Swiss cheese before our eyes. So, when kind of undertaking this analysis, we think that the best place to start is to pull a loss forecast, right? A loss run, rather, for the last 3 years, and to look at your frequency and severity over the last 3 years. And, we're really astute at catching the severity and kind of looking at our loss trends. And if your loss trend kind of peaks up above that retention line, you take that into consideration of how likely it is that you would, jump into that. But it's really important to look at frequency as well. And if you have, for example, in one loss year, you've got 10 claims that are just under that retention, that can be really bad news in a bad year. And that can, you would be taking on a lot more risk than you would have originally anticipated.
Agreed. Absolutely agreed. And I would say if you're looking to take a large deductible, say over $100,000, or even being even more aggressive and taking a very large self-insured retention, there's science to that, but there's also an art. And I think that when we're working with clients, it's starting with looking at the long term. It's very easy to just focus on the short term, but I think we need to be realistic about the why. Why are we doing this? And then working from here's where we want to be longer term, and work backwards. And in thinking about that, are we looking to, from a goal and objective perspective, are we looking to control costs? Are we looking to only transfer catastrophic risk and retain expected losses, or losses that we know are just frankly uninsured exposures? Do we really want to begin with a single line of coverage, and is this something that we could perhaps build out over time to create some type of multi-line position? Are we going to focus on simply some kind of insured retention, or do we want to look at alternative ways to finance that risk, either through a captive or some type of front secured with insurance, or whatever it might be? So having those conversations around the big picture is certainly important. But I think it's also important to think through what's the true operational and financial status of the institution. And you need to be honest with yourselves about that. What kind of, in doing so, doing not only a quantitative analysis, but also a qualitative analysis. What kind of mitigation efforts are in place currently? What kind of additional mitigation efforts might we need to take on in order to minimize the impacts of any kind of accidental losses that we could experience? And really, how comfortable are we doing that, both from an operational and financial perspective? Do we have the capacity internally to do it? Do we need to rely on external partners to assist us, and put that into some of the assessment that we're doing? So it's a balance of, here's our financial realities, but here's also our operational realities and what we can do to make sure that we meet our long, intermediate, and short-term goals.
Yeah, and I think too, for our audience, to your point about the financial realities of the institution, it's really important for risk managers to kind of understand their role in this process on two fronts, right? One is to understand the value that you bring, which is to describe the market environment that we're in, and kind of sell to your CFO or to whoever kind of your budget manager is why we would want to do that. So paint that full comprehensive picture that you're talking about. But also the second piece of that is to understand that you can't do this in a vacuum. You have to engage your CFO, your COO, if that's a role that you have at your institution, and even your general counsel to be really inputting on that big picture concept. The other piece where I think risk managers can add value is really understanding that there's more at stake than just the dollars and cents in your budget when you're taking on more risk. There's certainly operational and reputational risks associated. For example, if we take on more than $100,000 in a deductible, you're going to have to dedicate more administrative time to be able to manage those claims and to make sure that those bills are getting paid. That's going to take time and people. So I think that's something that you can add as well as a risk manager, is to say, here's all the pockets of things we need to consider before we make this decision.
All really good points. And I would say this too, when working with your key stakeholders, your CFO, your COO, your general counsel, or other key administrators within institutions, don't be intimidated by the cost of some of these solutions. It's really the risk manager's job, as you said, to really make the compelling case for change. And you need to be able to articulate why, in fact, that's so important and what the current problem is. So when meeting with your leadership team to lay out your compelling case, it's important to have, in my view anyway, a solid executive summary. As a mentor of mine and former boss, frankly, told me, you need to be able to put it on a bumper sticker. And so, in doing that, that bumper sticker needs to come with what's the problem, but it also needs to come with options, not just a solution. It needs to come with options, and you need to be prepared to bring your recommendation. It needs to be well thought out and supported by data and analytics, as we've talked about a little bit before. But it also needs to talk about the realities, again, of our financial situation. It also needs to consider what the source of funds are that you might utilize to capitalize a reserve to pay for those losses, those expected losses that you maintain. You need to think through fund administration aspects and where the money comes from and where the money goes, but also how you're going to utilize perhaps any earned interest income. Will that be utilized within the funds that you retain, or will that be used for other sources? Could it be used for loss control? You need to think about what's our plan if we're taking on some of these catastrophic type exposures and we're capitalizing a fund over time. What happens if we hit with losses, a big loss or a multitude of losses that end up depleting our funds early? What's our plan to replenish that fund? Also, and I mentioned it before, what's our emphasis on loss control? Exactly what will be the expectation for how we're going to work to mitigate losses and prevent them from happening, given this taking on this additional level of risk within our organization. And I would just say this too, it's critically important that risk managers ask themselves, am I aligned with the right partners, broker partner, risk management advisor, whoever they may be, that has the tools and the knowledge and the experience and the understanding of how my institution operates to help advise me and position me when I'm trying to present this compelling case for change.
Yeah, that's great. I kind of chuckle at your comment about the executive summary, because that is absolutely an art, and those that can put it on a bumper sticker, to your point, are often more successful in their careers. But I think the partnership with your resources, the partnership with your broker team, your advisory team is really critical, and to understand the resources that you have available and to use those resources, whether that's your producer, your broker, your claims team, or even if there's a data analytics service that your broker team can offer, lean into that and have these conversations. And really importantly, too, is to report out on progress. Is this working? has our decision really paid off in the long run? And don't be afraid to kind of support that and speak to that, and speak to the success of the program, but also be transparent if it's not working and understand why, and really start digging into that. So, Paul, thank you so much for joining us today. I think this information is really helpful as we are, entering kind of year one of a multi-year hard market. And thanks for being on Coffee with the Risk Manager.
Thanks, Stacie, and thank you, everyone. And honestly, Stacie, I can't wait to where we can actually meet in person again someday. I think we're getting really close. Take care.
I think so. Thanks.
Take care.